Recall that the importance of this section of business plan was mentioned in our earlier session on how to write a business plan. It is important that you will look at the video if you have not done that, as we will be making reference to the other components as we move on. The financial plan component is very important to the owners in convincing investors about the viability of their business idea, and in assisting the business owners in coming up with a realistic expectation. It assists the investors in determining the feasibility of the business, liquidity of the business, and how much they are likely to get per dollar invested. Do not forget to hit the subscribe button to stay up to date with our amazing learning sessions. In this session, we will take a look at how to draft a financial statement for business planning, the components of a financial statement and their projections, break-even analysis, ratio analysis, and tips on selecting the right method of financing that won't drown your business. Let's get started. Financial statement and its components. All business plan must include a financial statement to be complete. It tells about the financial needs of a business and gives insight on the appropriate method of financing to be selected. A financial statement for the purpose of a business plan should contain a statement of profit and loss, a cash flow statement and a balance sheet. Let's take a clear view at each of them. Profit and loss statement or the income statement. To come up with an income statement, you first need to have a projected sales or revenue figure. Depending on your line of business, if your business renders services such as laundry and dry cleaning, plumbing, hairdressing, etc., you should define the number of customers you intend to convert to generate that revenue depending on how much you intend to charge per customer. However, where your business is into production or sells goods, the quantity of goods that you must sell to attain the revenue projected should be stated. For instance, if you project a revenue of $1,000 and your business charges $10 per customer, you will need 100 customers to achieve your revenue target. Next, you will determine all the expense you will incur to acquire and retain these customers, e.g. rental of office space, your staff cost, storage and distribution cost if any, etc. The difference between your revenue and expenses is your profit, where revenue is higher than expenses, or loss, where expense is higher. Your revenue target should be based on your market and industry trend analysis, and the capacity of your business. That is, your revenue projection should take into consideration time, money, and capacity constraints. The next component of a financial statement is a cash flow statement. A cash flow statement depicts the movement of cash in and out of your business. Cash flow statement arises due to the differences between when a transaction is made and when cash is received or transferred. It shows how much cash you have at hand at any given time. A cash flow should include cash flow from operating activity, a cash flow from investing activity, and a cash flow from financing activity. Cash flow from operating activity takes a look at cash balances available from trading activity. It starts with profit computed in income statement after deducting for interest and tax, then increase in expense payable should be added, and a decrease in expense payable should be deducted. Also, where your revenue receivable increases, this should be deducted, and a decrease in receivables should be added to give accurate movement of cash. Cash flow from investing activity takes a look at cash movement, as a result of sale or purchase of additional asset. Where you have investment in another firm from which you expect interest, or dividend, this should be added here. Also, cash payment to acquire such share, loans you gave out, or debt instruments should be deducted. Cash flow from financing activity includes cash received from sale of shares or loans received from banks. Lastly, a balance sheet is prepared as part of a firm's financial statement. Herein the business capital, asset, and liability of the firm is accounted and projected for using appropriate accounting formula, i.e. capital plus liability equals asset. Capital refer to owner's equity contribution used in kick-starting the business or additional capital gotten from additional capital provided by existing owners, additional owners, or profit retained and reinvested. Asset is the list of all resources of a firm and their associate cost. Asset can be in form of current and non-current assets. Non-current assets are all assets likely to last more than a year, while current asset are assets that can be easily converted to cash and last less than a year. Liabilities are claims against a firm. It comes in form of a current and long-term liability, while current liabilities are liabilities that takes less than a year to settle, Long-term liabilities are claims against a company that takes more than a year to settle. Break-even analysis. Due to the amount required to cover startup cost and expenses, it is less likely to start making profit as soon as you start operating. Consequently, the need to carry out a break-even analysis to determine when your business will stop making loss, when cost will be equivalent to total revenue, and start making profit. Break-even analysis tells you how much your business needs to generate or how much product you need to sell to cover your cost. To compute your break-even point, take your total cost and segregate them into fixed and variable cost. Variable costs are directly attributed to your product or services. If you do not produce or render services, it will not be incurred, while a fixed cost is the cost associated with your business which is incurred whether or not you produce or sell a product or render a service. This includes staff cost, admin cost, advert, rentals, etc. Divide your fixed cost and by the difference between your price and variable cost to give you your break-even point. When your break-even point is too high, you either lower your cost, increase your price, or both. Profitability, liquidity, and long-term solvency ratio. The most important ratios in business plan are liquidity, long-term solvency, and profitability ratio. Liquidity ratio tells the investor how liquid a firm is, and how quickly a firm can raise cash to settle its short-term debt. This is determined by weighing current asset against current liability. Long-term solvency or leverage ratio determines whether or not a firm's equity is enough to cover its long-term debt. Profitability ratio determines the profitability of the business venture by weighing the firm's profit against their revenue. Method of financing. Finance is the lifeblood of your business. No business can survive without funds. Hence, it is important to know type of finance to access, when, where, why, and how to access finance. There are two forms of finance, namely, debt and equity. Each has its pros and cons. While debt can threaten your survival if not well managed, equity form of finance reduces your control and decision-making power. We will look at these two in detail in our subsequent sessions.